Hi, welcome. It's Mary Ellen McGonagle, Senior Managing Director of Equities here at Simpler Trading with your weekly Edge show for Saturday, January 22nd. So let's take a look at what we're going to be reviewing today. I'm going to share with you some pretty impactful group movement that took place this past week and, of course, drove the markets lower. Also, we will take a look at the current markets and beyond. And by that, I mean, we'll take a look at some of those underlying sectors and sub-industry groupings to give you a really good sense of just what is driving this market lower. And last up, viewer question of the week. And I am going to share with you a question that it relates to ways that you could potentially hedge yourself from this current downtrend period that's taking place in the broader markets. First up, let's take a look. Where did the markets close for the week and what can we potentially anticipate going forward in the near future here? First up, we're taking a look at the S&P 500, and this is a daily price chart. We can see really just how much damage took place last week with the index down 5.3%. Pretty high volume characteristics here, which is not what you want to see as well. So a couple of items that occurred. We did break two key levels of support last week, and the first up was that 4,500 level. This is something I've been identifying for a while now. Subscribers to my MEM Edge report will know that. And then that next level is this blue 200-day simple moving average, and we did close the week below that, so not constructive. We can see the RSI, this is a momentum indicator, relative strength is now down into an oversold position. So that could get really interesting as it relates to the markets trying to find a bottom or a floor, certainly over the near term. Stochastics, these are a faster moving momentum indicator, and we can see that this is now down below that 20, still in negative territory. So another area that is pointing to potential further downside for the S&P 500 from here. Let's go ahead and take a look at the Nasdaq. The Nasdaq did hit a corrective period this week, down more than 10%, but at this time it's closer to 15% down from this late November peak in price, has broken through key support, and by all accounts does appear poised to trade lower. I'm going to share with you some of the subgroupings and why this may be the case. RSI, that relative strength indicator, also in an oversold position on the Nasdaq. Stochastic, so we do have very similar dynamics here, but both are in a negative position. From here, let's go ahead and take a look at some of these underlying sectors. These are the 11 sectors in the S&P 500. We are viewing a 2-month daily price chart. I've gone ahead and added an RSI, relative strength indicator, and sorted it in descending. I'm going to go ahead and update that. And we can see up here in the forefront is energy. And energy had a stellar week last week in an otherwise dismal period. This week, it did close the week down just a touch. But let's look at the dynamics on today's trading activity. We can see the XLE, the energy ETF. Buyers did come in on the dip so that it closed the day in the upper reaches of its trading range for the day. So certainly constructive. The RSI up here in positive territory, this MACD, we're going to be on the lookout for a potential black line down through the red, which would signal this uptrend is over. But however, we are not there at this time. So other areas up here in the forefront, consumer staple and utilities. And of course, these are defensive areas of the market with the concept that the need for their products and underlying services will still be in demand regardless what may be occurring elsewhere. And then also we want to take a look and be aware of some of these really down and out areas. And first up, I am going to share with you consumer discretionary. This particular industry group was the worst performer. It was down over 8% on the week. A couple of dynamics here. Amazon and Tesla are the two top holdings in XLY, and both of these stocks were down significantly. Amazon down 12%, Tesla down 10%. But that said, retail stocks in general are under pretty heavy selling pressure, and a lot of that consumer sentiment due to inflation fears. We saw retail sales for December was declining, so not a good backdrop as it relates to these discretionary stocks. We are currently in an oversold position. We may get a bounce, but overall, a lot of damage that will need to be repaired before we can get back into these consumer discretionary stocks. Another area that I did want to share with you, certainly another heavyweight sector as it relates to my work, is technology. This is XLK, and we can see the significant drop in technology stocks, all about rising interest rate environment. And now, of course, there are fears as it relates to growth prospects going forward. Next week, we will see Microsoft report and other growth names, which may provide more insight as corporations give guidance going into the remainder of this year. So we can see XLK is right here at this 200-day simple moving average. We can see that RSI down trending lower, as well as this moving average convergence divergence. That's your MACD. So not looking very constructive here. Let's go ahead and move back and take a look at one other sector in these sub-industry groupings that I did want to share with you, and that is financials. Financial stocks had been holding up well, primarily because bank stocks fare well during a rising rate environment, which is what we are in. Interest rates trending upward ahead of the Fed increasing their borrowing rate. And we can see, take a look at this drop. And this is all about earnings. Bank stocks begin the earnings season, and the numbers were not great. A lot in the way of high expenses. So unfortunately, the downtrending earnings scenario is more impactful than that rising rate environment, so that we are getting further pressure in areas that otherwise would support the markets. From here, let's take a look at some other sub-industry groupings that are quite impactful on the markets. So I do have each of those broader market indices, the Dow, the S&P, the Nasdaq, and also small cap stocks. We're going to take a look at yields and then some of the bigger industry groupings within the markets as it relates to, again, being impactful. So again, RSI, relative strength, we want those stronger areas up here at the forefront so that you can then from there determine what areas may be able to withstand the broader market's downward pressure. But first up, we can see the Volatility Index. This is the VIX, and this is better known as the Fear Index. Pretty significant increase this week as it trends higher. We're now down up here at that 28, 29 level. This more recent spike here in December was all about that Black Friday flash crash, if you will, when Omicron first was discovered. And then we did see a continuation of the fear up to that 35 level before we got a relief rally by way of that Santa Claus rally, if you will. So we certainly are entering into positive position. If you look at the chart, however, this MACD points to further upside in this VIX and hence in the volatility in the broader markets. From here, we can take a look at Brent crude. We can see it's up at about 88. Very significant increase here, and energy is by far the best performer year to date, and a lot of underlying stocks here that are still holding in quite well. Energy does well during a rising interest rate environment, and then also gold holding up well as a potential hedge. There are a couple of bright spots there as well for those that are inclined to, again, look for those hedges. But let's go ahead and move on and take a look at some of the more impactful on a negative basis. And I did mention to you bank stocks. 9% drop on KRE. This is that regional banking ETF, again, all about negative earnings, negative outlooks going into this year. And really, this is what you need to look for if you are in a group that's holding in well, the momentum shift, that black line down through the red, as opposed to this bullish black line up through the red when the group, any group really, potentially moves back into favor. One other area that really got hit quite hard this week, this is Semiconductor Stocks, SOXX, down over almost 12%. And we can see that the decline is taking this group right down to this 200-day simple moving average. Huge volume characteristics as the group continues to deteriorate. This is an area that did have strong earnings last week, mixed earnings this week. Despite the chip shortage, the group is under distribution. So from here, I did talk about that concept of potentially hedging against this deterioration taking place elsewhere in the markets. So I am going to share with you a stock that is in that consumer staples space. They already did report their earnings. This is Procter & Gamble. PG is the ticker symbol, well-known company, certainly within that staples space. They have a lot in the way of cosmetics, paper products, and so on. They did come out with very good numbers this week, and it's all about the ability for companies such as Procter & Gamble to pass along any increased costs that they have to the consumer, which in turn is improving their revenues. Last week, we can see that the stock did break out of this base, and we can see the momentum is poised to shift. If this black line crosses up through the red, your RSI trended up here into positive territory, and a nice 2+% yield on Procter & Gamble as well. From here, we can take a look at a stock in the utility sector. I did mention to you that that is an area that is defensive. We're going to take a look at Sempra Energy, SRE. This is a 3.2% yielder. Nice uptrend in the stock, and it's pulling back very orderly to this upward trending 21-day simple moving average. Your RSI up here in positive territory. Now, from my work, I would like to see this MACD trend higher, so perhaps more of a watch list type of stock at this juncture. And when we do see that black line up through the red, this 3.2% yielder could be a nice hedge against what is occurring elsewhere in the markets. And then last up, I am going to share with you an ETF that is holding up really quite well, and for sound reason. This is Dba Agricultural Fund, ticker symbol DBA. It's Invesco's fund, and we can see that it is poised to break out of this nice 6-week base. Agricultural is all about, this is another area, if you have an ability to increase pricing that then gets passed on to the consumer, you will fare well. And then it is also part of a commodity grouping that is now being viewed as being in a 10-year super cycle. It is another area that fares well during rising rates. So this could be a potential hedge against what is occurring elsewhere in the broader markets. That's it for this week. Everyone have a great rest of your weekend. I look forward to seeing you here next Saturday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.